right. It says we're being live streamed, which is great. And I'm going to hit the record button.
Okay.
And I'm going to hit the record button.
Okay.
Oh, we're live already.
Well, there we go.
I jumped the gun by 2 minutes. I didn't mean to do that. What did I do there?
Oh, it's okay. We can go. I mean, a little bit.
Okay.
Chit chat in the room for everybody.
Yeah. Okay. So we have people coming in.
Hello, everybody.
All right. Everyone, just drop a comment in the chat to let me know that you're here. Recording is in progress. Oh, Jonathan. And Tim, hello. Right, Jonathan, going right into it, asking if we're going to be able to trade Forex. We don't know about that. iFlip is not a Forex trading platform yet. Maybe one day in the future. But okay, we are live, so let's get right into it. Welcome everyone. Today marks the October edition of the AI Circle with yours truly and Kelly Korshak. But before we can do anything, we have to get through the disclosures to make sure that you understand we're not giving out any advice here. Everything is just our opinion for educational purposes only. So please bear with me as I go through this disclaimer. iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instruments. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. With that out of the way, I'm going to pass the mic over to none other than our CIO, Mr. Kelly Korshak. Take it away, Kelly.
Thanks, Aaron. I almost feel like I should take a bow, but I'm not going to do that, everybody.
We'll set that up for next time. We'll have you step back and bow on stage.
Never going to happen. I'm feeling it. These things, I feel like Kudlow, after the market closes. Mm-hmm. By the way, everybody, thanks for being here again for the our monthly AI Circle. I might change up a few things today, but I'll do what I normally do, which is kind of talk about the markets and opine, and have a few little things maybe on the AI I can show you. Maybe even talk a little bit to Jonathan's early question of currency, being able to trade something that represents the currency markets. As well as what we did in Dallas, and as well a little bit on that. And so rather than continue to talk about what we will talk about, let's kind of get into it a little bit as we usually do. And again, thank you everybody for being here. Aaron, can you please share the screen, please?
Sure, you got it. Let me stop my share. And that you should be able to share yours now.
Yep. That sure looks it. I'll get over to this in a little while, everybody. I think hopefully you can see my screen. Does everybody see my screen?
Yep. We're good.
We're good. Good.
Mm-hmm.
All right. Let's start with, it's always about the S&P 500, everybody. I don't know how many of you watch the business news or periodically turn it on during the day. There's basically 3 business shows. There's CNBC, Bloomberg, and Fox. Each of them has their little twists on the markets. The best is probably Bloomberg. The simplest is Fox. And the most, the loudest is CNBC. Each of them have their advantages. And each of them have their guests on the show. And the guests on the show are a lot of people that look a little bit like me, maybe, where you see the top of their head, maybe the tie that they have on, and sitting behind a desk and telling one of the commentators something bullish. So the idea of the markets, of course, as everybody knows, is they want to look, when the markets are going up, they say it's a good investment. When the markets are going down, they say, should we buy? Nobody is definitely ever talking about, should we ever sell? And as you know, everybody, this year, we've been pounding the markets. I was bearish in the beginning of the year, and I was bearish because of this. Pardon the code. Pardon the code. I was bearish because of this. Early in the year, literally right after Christmas, we had a sell signal. I don't know if you can see it, but you see these little AI things, if you can see it on your screen, each of these are little AIs, which means this was an example. And by the way, I just made it so that when I put the
are those green dots?
They're like green dots, but if you look from my perspective, they're literally a little A and a little I.
Oh, okay.
I put them up there for myself so that I can make sure how the AI integrates with the execution algorithm and the signals.
Mm-hmm.
So we had a sell signal up here at the end of the year. And then after that, normally we would have had a sell signal right in this area here, right around there, or in this area here. But the AI was turned negative literally early in the year. And that kept us from a signal here that we would have been stopped out down here. The AI turned off, we got that buy signal, and we took a loss. And then the AI turned back on. Then it happened again, where the AI was off, and we took a signal, and then we just got out. And then we've been out for the rest of the year. And so here we are. Let's update that to current, if it's not already there. There we go. Here's the little rally. We're still out, and here's where the market is as of yesterday. And so we've been out for literally, except for these two trades, we've been out at the beginning of the year. But when the AI changed the signal, that was the main reason why I offered caution early in the year. And that's this area here. I like this black chart a little bit better with the black background. But I think what's also interesting is the market started to go down. You might
Black charts are easier on the eyes, right?
Yeah, much easier on the eyes. The market started to go down. I think everybody on this AI circle and those who have spoken to me privately or in public, like at the Dallas show, I've become obviously more aggressive and bearish in the market, and with good reason. And it was as I've told you over the last 2 months, the lower lows and the lower highs, lower low. Here was a good rally the last time, but still then another lower low. I expect the same is going to be true here. No market goes straight down. It just doesn't go straight down. This will take another year, a whole year, folks, which means that the AI is right now embedded to remain out of the markets. Now, the good news is a lot of the expectations for the markets, and they're all over the place. There's people that believe the market will be at 4,100 to above that by the end of the year, and they expect Santa Claus to arrive with his Santa Claus rally. And I'll get to that. And then there's other people, of course, that are very bearish, and they feel the ultimate move down in the S&P is to 2,900. I'm more in the latter camp. So for now, cash is good, but there's some other plays that we're going to start having to take a look at, and there'll be smart folios built around it. And one of them is going towards the currency market. So to me, this still looks like a bearish chart. The AI is negative. Algorithmically, we're in the negative, which means it's not going to find signals to buy. So even though we're under one of these little rallies again, I'm fully and deeply suspect of it. That's something, so I want to do that. But I got to make sure that I don't pound the table, and we never want to say that we're too bearish, because I can tell you that's just as bad as being always bullish. One of the things I'm noticing in the currencies, because we've been talking about those, is the dollar. Notice something. The dollar has been on a huge ride up. Recently, it's come off of its highs in a pretty good way. So we were at 114, we're now at 109 area, almost a little about 110. And that's, that's a pretty good decline. Every 1 point, figure that's about 1%. So the dollar's about 4 to 5% off its high. But if you notice something of a pattern, the higher highs and the lower lows. So it makes a new high. Then when it goes down, it doesn't make any newer low. It makes a regular low and then makes a higher high. Moves down, makes a higher high. Moves down, makes a higher high. Moves a little down, makes a higher high. Notice here, we went down, we did not make a higher high. We challenged it again here, and now it's rejecting it. What does that mean? It doesn't mean the dollar is stopped at all. It just means right now the dollar is off its highs. And to the markets, to the stock market, guess what? That kind of looks good to the stock market. Right now, I feel the currency markets are helping lift the US equity markets. The only other thing that affects the US equity markets is the interest rate market. Let's take a look at that. So I'll use, in this case, let me see if I can find the TLT. The TLT is an ETF that represents a 20-year US Treasury. Basically, US Treasuries that are 20 years out. Now, this market also, since the beginning of December, has peaked. But take a look back how much higher it was. In other words, these high prices over here in the TLT represent the lowest interest rates we've ever had. And this is back, as you notice, in March of 20, when COVID started. Interest rates, that's when they went to zero. But ever since they went to zero, the long bond, the 20-year bond, almost the longest bond, 30 years the longest in the US, has gone down. Recently, another thing that helps lift the stock market is, look at this. They've rallied a little bit, which means interest rates have actually come down a little bit over the last 3 days. Those are that between the dollar coming off its highs and interest rates just over the last 3 days kind of coming off their lows probably is the reason why we see the S&P coming off its lows. So, but this is perfectly normal. I submit that this is a bull market for the dollar. I submit also, and I doubt many people would disagree, this is a bear market. These are the two fundamental markets that drive the US equity markets. Mm-hmm. So if we have a bear market in bonds, which means interest rates are going up, we have a bull market in the dollar, which means our currency is becoming stronger and stronger. Why? Well, because guess what? Our interest rates are higher than most other places around the world, especially the West. And I know I've said this to you guys before, but remember, if our interest rates are higher here and you're a European, might be wise to say, I can't get any interest in my own bonds, so I'm going to go overseas and buy them. So what do? They sell their euros, they buy US dollars. That's why the dollar goes up against their currency. Then they go ahead and then they buy interest rates. And even though their price of their interest rates that they purchased has gone down, they're getting a yield. They're not really planning to sell their products. They're just holding it for the yield. That's the reason for the little dollar rally up, or sorry, the S&P rally up. At the end of the day, I also would think that most people would look at this action and say, this is not something to look to buy, but that's the way the pundits on TV speak. Let's look to buy. Market goes up, let's look to buy. Market goes down, let's look to buy. And that's the training that Wall Street gives us.
Yes.
Over at Flip, obviously we want to reject that training and that philosophy, and we buy only when the market tells us to buy. And just so you know, our AI does look at foreign exchange rates, and it does look at interest rates, obviously. So in my opinion, the dollar is still strong and it should be bought. The interest rate market is very weak and we should sell our bonds. And finally, the stock market, we should just sell also. That's the trend. Until we are taught otherwise, what we should do is either, if we're long-term traders, we just wait this out and the opportunities will present themselves literally in the 6 months, 12 months in the future. And then when they do, that'll be our opportunity to be able to do very well in the subsequent 12-month period. So I feel that, again, America generally will come out of these things. It's been through them before, but the opportunities are getting better and better as the markets weaken and adjust to the new world of fiscal governments not injecting capital into their markets, and Federal Reserve banks and central banks around the world also tightening their supplies of money that they put out inside of their respective economies. So to me, I would be a seller of this rally at some point. I also think another thing I want everybody to be aware of, because we just looked at the dollar and we just looked at interest rates. I have to say that the interest rate move in particular is almost pathetic. Look at this. This is a pathetic rally given what's happened. We moved from 145 to 117 on the futures. That's an enormous move of rates. And we've rallied literally 3 points as if that's the beginning of a new trend to lower interest rates. I don't think so, folks. But here's the one I want everybody to really pay attention to. You ever noticed how the Dow Jones is really prominently displayed on the TV of any of those business shows? The Dow Jones represents a terrible index to watch. The broader market is what matters. So the Dow today, look at this. The Dow actually eked out a gain today. Matter of fact, it's even closing in this yellow line as a 200-day moving average. Look what happened the last time. I hope the Dow can go here. Because if it does, obviously, the person that is talking to you now will find a way to be short. But we're not that way. I'm not trying to get people into the short side of the market. I'm just saying that the opportunities are not to be buying the market here.
Right.
But look at this. This is a misnomer of the market. When I look at this 30 index of the top 100 companies in the world, or top 30 companies in the United States, that shows something that is not a reality to me. The reality to me is more along, will always be the S&P 500. This chart doesn't look anywhere as good as this chart. And let's look at the NASDAQ. We had, obviously, the NASDAQ today was down over 2%, but the Dow somehow goes up. That shows you bifurcation. That means something is dislocated. Dislocation is the joy of traders. Traders like to dislocate when they see markets dislocated. The NASDAQ, under a circumstance like this, was weaker than the Dow. So the trade under a dislocation generally is on a day-to-day basis is you would fade the opposite thing that happened. So tomorrow, I might expect that the Dow to be weak relative to the NASDAQ, and I would sell the Dow and buy the NASDAQ and hope to see it change around the other way to adjust to the dislocation that occurred today. But this tells you that this market is still very, very weak, and there is no way this market should be that strong, which tells you the dislocation exists, why we must remain out of the market. So those are two things. And that's how currencies, interest rates, and stocks, and particular stocks indices kind of stay together. They work relative to each other. And
Kelly,
so,
just
go ahead, Aaron.
Real quick question here. Why is it that, when the Dow is only representative of 30 companies, it has its place amongst the other indices that are way bigger, and it's featured, very prominently at the top of the list sometimes. Why is that? Why does that
It's
happen?
the same reason George Washington is on the dollar bill. It was the first index.
Got it.
And many, many years ago, when it was formed by the Dow Jones Company, really, there was only maybe 50 stocks in the whole US you could ever invest in. So they decided to create an index with just 30 of them.
Right.
And those 30 stocks represented the employment picture in the country. In other words, those 30 stocks were at that time were Ford's, General Motors, General Electric, the companies that you would know that existed in the 1920s that created the employment for America.
Right.
But today, the Dow Jones contains a company called, for example, Salesforce.com. Well, they might have 30,000 employees or 40,000. Does that represent the American employment picture? No. Disney does, but does Salesforce do that? No. Why? Because the Dow Jones Company that sets this index, they designed it now to just simply go higher. It doesn't represent an economic picture anymore of the country. The economic picture of the country is best described always in the S&P 500.
Right.
Personally, I don't look at the Dow.
Okay.
I don't look at an index that can go up when I watch the other indices go down significantly. For example, the S&P today was down 0.75%. That's obviously a dislocation. We don't want to see that. The VIX ultimately was higher at the end of the day as well. This is, remember, a delayed quote. So when you see things like that, obviously I can't trust them. What I do trust is where certain markets are going. And if you just look at most of the markets, if we just pick them out, like a Google. Okay, look at Google. Google today made a new low. Does that look like, I remember a pundit came on TV in the morning saying, buying Google here. Well, he owns it at 96.56. He's already lost almost $2 on the trade. And he said, this is the best buy. This is a great company, great earnings. Maybe so. But my guess is this is going to go lower. And if this goes lower, that means that the NASDAQ index goes lower. It's just a matter of time before the ghost is given up in companies like the Dow. So if we look at other companies, look at Microsoft. Look at that. This is the fourth lowest close over the last 2 weeks in Microsoft. It 1, 2, maybe the third lowest close in Microsoft over the last 2 weeks. That doesn't look like a good chart to me. Let's take a look at U.S. Steel. That really looks like it's on a rampage going higher, right? I'm being facetious, folks. Right? AT&T, I will give it. Look, AT&T has rallied. That's a nice rally, but look where AT&T has come from. I don't mind owning AT&T because it pays the dividend, and it's a good dividend at this price. The ones I still like, as everybody knows, are these. It's not going anywhere yet, but you notice in a government full of hatred towards pipelines and infrastructure for oil and gas, this stock pays 8%. Jonathan, yay, keep out there. This is something I've talked to you about in Dallas. It yields you 8% here, and look where it could go. Sure looks like it could go to 23 possibly if there's ever any love coming back from the powers that be out of the White House to be able to get our energy, our country's energy back on track. This could double. I don't think I'm going to see too much more lows. I don't think we will get to COVID lows of $3 a share when gas and oil was priced negatively. I feel this is the true range of the product. And it, by the way, seems to, it's really in a range, but it seems to want to kind of go higher. But don't think that this is going to jump up anytime soon. This is a 1.5 to 2 year play. Let's look at the banks real quick.
In the meantime, it's a dividend play, right?
In the meantime, it's paying the dividend. So that is very, very important to everybody, folks. 1 second, I have to move my leg. I got a little cramp. Don't know how that happens. Pardon me, folks. All of a sudden, periodically, I got to have more potassium. The bank stocks, by the way, here are not really also looking that good. Sorry, the cramp is painful. Give me 1 second, folks.
Kelly, if you want to take a few minutes, I can address some of the questions here if you want me to do that. Yes. Okay. All right. So, Jano, just to answer that question, if you could just stop your screen share, Kelly, so I could take over. So, Jano, that the symbol for that just now was PAA. That's Plains All American, I believe.
All American Plains. I'm okay.
Plains.
Thank you, everybody, for tolerating my craziness. So,
okay,
yeah,
great.
All Plains American and Energy Transfer.
Got it.
And I want everybody to recognize these things. Energy Transfer and All Plains American are both paying around 8. And again, I'm opining. But look where they could go. That's
more than double, right?
Yeah, this was COVID. So we're kind of recovering from the COVID areas. The COVID area was here. And so we're kind of close to that, but that means the price of the stock would maybe go up 10% more. If you buy it here, you got 8%. You can buy this, by the way, everybody, by just taking red oil, because red oil features these things prominently. But my instinct is that this is going to recover to 2016 areas where I think it'll more than double. So these are the things inside the Smartfolio of red oil you can get. All you got to do is put money towards smart oil. And remember something else I want everybody to know about the platform. When you put money into a smart oil or any portfolio, we are only measuring the price change. So if it says it's up 5%, for example, it is not including the dividends they pay out. If you include the dividends, these numbers are significantly higher because we pay attention and we construct a moderate portfolio and anything conservative or moderate or red oil. There is dividends that are behind these things that come into your accounts through cash. If you ever look at activity, you might see that you'll see, hey, dividend paid. Should look in there. That is not being counted in our performance. I keep that out of there and like that out of there for a reason. What we want to do is show absolute performance. It doesn't matter if it's a dividend. If it's a dividend and you get good absolute performance, what else could you want? Mm-hmm. And that's why if these dividends are prominent, remember, they could be over a year's time as much as 5 to 8% higher than whatever it shows. So they throw off income. And so for people that want to take a good, safe play, I take things that are dividends and they're long-term infrastructure plays against the trend of what the right now the government wants to have, which is to move us to electric far too soon and get rid of our infrastructure. That will not happen in my lifetime and likely many of the lifetimes of the people watching this little podcast. So that's just a heads up. And I think most of the people on this that watch this webinar are people I've probably talked to, and you've maybe heard me recommend these things before. Sorry. I can't make a recommendation, but this is when I speak on this webinars, these are me opining. This is where I put my money. Just buy red oil, folks. If that's what you like and you believe in what I'm saying, go there. Now, I want to kind of touch on something else really important, and it's, again, going towards these currencies. I don't have them up there right now, but we've had these little rallies in the currency like the euro today and everything else. I feel that this is probably not the time. We have made, if you can see it, a series of a lower, a high, a low, a higher low, mm-hmm. and then a higher high. This high here is higher than this, and this low here is lower than this. generally there's some expectation of where this will end. My expectation is we're pretty much near the highs already. And my, ongoing expectation is the euro will remain in trouble through the next 6 months, and it could go higher, but I still expect it to go lower in price over time. However, what I'm learning, and I'm investigating, and I'm not having them up there for now, that there is a way that we might be able to participate in this through some ETFs. I'm looking at them now. And if I can find it, I will put together another smartfolio that we'll probably just call it FX. And that would represent a possible trade that could be made, an investment inside the currency markets, right from your Flip platform. You don't need to go anywhere. I'm just verifying that I can create something that manages risk on something like this. The good news is it won't be levered. So levered product is where you get risk. Foreign exchange is known for its leverage, but that doesn't mean we can't participate in it. And so just so you know, when you move like it has today over the last few days, we've moved from 97 to par 100. And that's more than a 3% increase. Well, that's happening only over 3 days. That's volatile.
Yep. Especially for the currency markets.
Yes, very volatile for the currency, even for the currency markets, which are volatile. But if they're levered and volatile, that is a very dangerous place to be. It's a good place if you're a trader, for those of you that went to Dallas, but it's a bad place if you're an investor that is trying to maintain security in your account and overall growth. We all like to hit home runs and make a great trade that makes us money. But I think a lot of you are familiar that many of you were involved in the Exxon trading, and that was a good trade. I feel there's a trade like very similar to that can be constructed inside these markets as well. And no one likes things like that better than the person talking to you. I love to be able to create things that have a risk management strategy of how to go about in making an investment in something like a one-off, which is currencies. So
Kelly, could you give us a little bit of a preview on what the proxies might be in the equity markets for some of the currencies?
Let me see if I can get you one of them. I'll go over here.
Yeah. Because we can't trade these pairs directly because this is the spot Forex market. So they might want to see what they would what the equities would be, or what the ETFs would be inside of a Flip smartfolio. And if you were in Dallas, you understand what I just said. If you didn't join us in Dallas, maybe you should consider getting the recording of it so that you can understand some of this Forex and futures terminology a little bit better. It's the shameless little plug there.
Shameless
plug.
Hold on, I'm trying to find it here.
That's okay.
Offering on the London Exchange or the MCI, Morgan Stanley, if I can find it. Because I was playing with them on my main platform, and there.
Does Velox offer stuff from the European exchange?
Yes, we can do that. We can do some of them. And the ones I already checked with the clearing firm. Hold on.
Cool.
Trying to find one. I wasn't prepared to go there, and I don't want to go this one. Hold on, folks.
Yeah, sorry, I threw a curveball at you, Kelly.
Yeah, it's okay. But that wasn't. I had. We do this while we're all on the phone, folks. Yeah, it's the ProShare product. Here we go. Hold on.
Oh, the ProShare. Okay.
Yeah, I spelled it wrong. Of course, leave it to me.
There you are.
There's the ultra short euro, but I don't want that. I want the reverse of that.
Oh, I see.
Right. So here is an example of a reverse product. However, it does have volume, and a reverse product, as long as it has no leverage, is good. So basically, see, it's literally a ProShares ultra short euro. This one does probably have some leverage,
Yeah.
but you can see that this is the inverse product of the euro. Because if I change to the euro, let me put that on the watch list. Control watch. I'm sorry. Shift watch. Thank you.
Their shortcut is Alt W. Yeah.
Did it.
Yeah. Yeah.
So if we go to, this is the one product, here's the euro. You can see this is the euro versus the dollar. Euro is getting weaker against the dollar. And notice that this product is the euro, the dollar against the euro. So the dollar here got weaker against the euro. It's basically they're one's divided by the other. But these products exist. If they exist, that means we can do it inside of our own portfolios as long as our clearing firm offers it. And I know on 2 of them, it does. The other one, by the way, is the yen. And we're now kind of spelling at things outside of the purview of what we do. But this is important because this is how money can be made, and we can take some different kinds of bets. If we know the stock market doesn't feel right, we can look at these things and maybe put a little bit of money to work here. And again, through a smartfolio, I really recommend that because these are difficult to manage. So wait for the smartfolio to come up and we can aggregate these things and find a way to be able to invest in them without having too much risk. So we have a chance to be able to make money or improve the performance of your portfolios during a time when we can't find the same opportunities in the US equity markets.
Yes, absolutely. So this actually addresses a bunch of questions that we actually did get about an update on the yen.
Yep.
Because we've been talking about currencies for the past couple of episodes now on the AI Circle, and this is just another preview of what we might be able to trade inside of a smartfolio, right? So this is more of a ETF. Is that correct, Kelly?
It's an ETF. Yes.
Yeah.
And by the way, everybody, just know that yes, I believe in the math of investing. You invest, you use mathematics. You all know that. And we also know that math is one thing, algorithms are one thing, artificial intelligence or machine learning is another thing. Those are all fine and good. But when we developed red oil, we didn't do it that way. We developed red oil because it was opportunistic. It was a predatory move in a portfolio that was created because there was an opportunity due to COVID. So we built it. Obviously, most of you have had good success in that, if not great success. The other thing, though, is this is another one of those opportunities. This is something at the abyss of COVID, which really didn't last that long. A lot of opportunities existed. And I feel there's a lot of opportunities here. So the platform is not just about using math. It's now about being predatory. Where do we find an opportunity, especially in a time when it's hard to invest our capital in the markets? Where do we find an opportunity somewhere that could be developing and then have an organized way of it being involved in it? So I look at things, I like to be organized and involved in so that if I get hit by a bus, everybody, something is going to continue to work for you where you don't need me. So that I will not put things together assuming that I can guide this myself, because I can't. And you don't want me to, because that's not what's best for you or me or the company. Now, let me show one last thing, though. Everybody knows, I've been becoming more aggressive on the bullish side of the market, on the bearish side of the market. But recently, my old boss sent me something, and I want to share it with you. I'm going to leave it on this side of the screen because this is my email, and I can't pull this out. He copied and pasted something, and I got to give credit to, this is a company called the marketeer.com. It's a newsletter that he subscribes to. And this will give you 2 ideas. And the reason I'm going to share it with you is because one of the problems with people that are bearish and become very aggressive bears is they won't be able to see when the market is turning. So the more I pound the table of saying, man, I don't like the markets, I think they're terrible, the more I have to question myself and be able to look at information that doesn't agree with me and really look at it and give it its due. This email here talks of a bullish scenario towards the end of the year. I read through it. For example, a bounce could involve and turn into a year-end melt-up. They talk about some CTAs that are trading in certain kinds of currencies and that they're all short. Of course, CTAs are short, because if you're short, you're making money in the markets, the bond market, the dollar market, the equity markets. Of course, they're short. And they make that point and say, you know what, everybody's short. If the market starts to go up, they have to buy to cover their shorts, and that could create the market to melt up. Whoever the author is correct. That would happen. However, I question that, because generally CTAs are long and short, and they look to short moves. Like right now, I could tell you they'll be looking to short the dollar. They're just not naked. CTAs are never naked, completely long or short. They're trading in and out of their positions. So it's naive to think that they have a long position and a buy and hold on these shorts, just like an equity investor has the buy and holds on their longs. That's naive. They're talking about here another one where equities defy interest rates. So right now, the equities are down far less than the interest rate market. The interest rate market has plummeted. I'll give you an example for let's take a look at bonds and the TLT and see how much that's gone down. So the TLT from the beginning of the year was about 154 and it sits at 96. Well, to me, that sure looks like it's down 33%, right? About, maybe a little more, 36%.
Mm-hmm.
But the US equity market and the S&P 500 is down only 20%. So in other words, the equities are defying the interest rates. Interest rates always lead. Stocks lag. The bond market, everybody, is 30 times bigger in money, in dollars, than the US equity markets, which means most people have most of their money in this country in debt markets. Just a heads up. So one market has much more capital than the other. I generally believe that the more money is the more reality. The more money invested in something represents the larger scope of what's true. Interest rates, when they start to move, they will move for years. And I don't think we'll ever return to a zero interest rate environment. So that's how I would respond to the second item on this in this email. Now, here's a bet here where another thing they say is there's more. JP Morgan says we do not forecast a recession. That one is almost blatantly, to me, I would answer, seriously? I mean, JP Morgan is known as the worst wealth manager on the street. If you're in the wealth management or portfolio management business, the only reason you would ever work at JP Morgan is not for their acumen, but rather for their money. I personally never wanted to work for JPM because I don't think they knew what they were doing in terms of their capital markets. They're the biggest fish out there, but they're awful at portfolio management.
Can you dig into that a little bit, Kelly? Because I think that's very poignant what you just said. You know, how could you be awful, but one of the biggest fish in
because everybody goes to a bank. JP Morgan, along with Bank of America, are the largest banks in the country. Most of the deposits sit in those two banks. And when people go to their banking, most people open up their brokerage accounts in these kind of companies. When they open up their brokerage accounts, they get literally the worst product possible. Because guess what? They don't have to pay very much. They don't know to be able to open up an account at TD Ameritrade or Fidelity. Only the people that know a little bit about the business realize that I won't trade my money at the Bank of America or Mellon or Wells Fargo or JPM. I'm going to open up an account at TD Ameritrade or Fidelity directly. That's what they do. But believe it or not, most of the people, they associate banking and investment with the same thing. That's why. Now, why does JP Morgan not attract good talent to run their portfolios? Because they don't want to experiment. They are banks. They don't experiment. They only offer the basic, most basic of product. It's naively conceived. It's naively managed. I can't remember a good money manager out of JPM in my lifetime. Notice that Bank of America during the 2008 financial crisis, they bought Merrill Lynch because they always wanted Merrill Lynch because they wanted to compete for the assets of their depository accounts, for their checking accounts, to be able to compete better on their investment accounts. They always wanted it. They ended up buying Merrill Lynch for a song in 2009. So when I see, going back to my thing to answer Aaron's question, I do forecast a recession. Now, whether that recession looks like previous recessions, I doubt that. I don't think it'll be as bad because it's, we're coming, before a recession would be when we had 1.5% growth and then we go down to 1% growth. Well, that matters because that's all the growth we ever had after the 2008 financial crisis. Now, however, we have GDP that is running at 4% and even 5% over certain quarters because as we recover from COVID, for it to go down from 5 to 3, yes, it would be defined as a recession, but there's still a lot of growth, more growth under a recession than we had for the 8 years, 10 years after the financial crisis. So a recession is a recession, but it may not look the same as previous ones. But nonetheless, it is a recession, and we have a different problem in this one. This one, the Fed must raise rates. They can't lower rates to protect the country from the recession, which causes job loss. Because the rates were all, the reason we had it is because the rates were too low and we had to raise them because of inflation. So again, this argument I don't like. Q3 could be another quarter. This is talking about earnings making expectations. Earnings are always designed to beat. They beat by a penny. Even if they reduce earnings, and that hurts a company, they reduce earnings to such a point so then when they make their next forecast, they're able to beat it by a penny. 1 penny. Say, we did better than we expected by 1 penny. So I say that in jest because that is a racket. It's a game that they play to be able to keep the street happy, to keep investors saying, hey, we beat expectations. Why are you selling my stock? So I don't like that argument. This one, another one, sentiment, I can go through them all, I won't. But where I'm going here is, and this is something I think will tie into something else, it's a kind of a clue to our AI, is sentiment is awful. They're showing here that, look, in 2020, sentiment was awful right after COVID. They're showing here in 2016, this was the Brexit area, 2016. We had a trade war. We started the beginning of the Trump administration, and the country wasn't looking good when Obama left. There was that. And then, of course, Trump created a rally. We look at 2012. I don't recall the 2012 thing. This is a back test, you can tell over here, which is still valuable. 2008, it was terrible. But just remember, 2008 was terrible. Look what sentiment was in 2007 when the market was going down, which is here. It was very high. Market went down in 2007. It was up 20%, ended up the year 4%. Nobody knows that because they think, oh, 2007 was an up year. It was up 4%, but it was at one time it was up 20. But look where sentiment is. Sentiment was very high and the market went down. That being said, I'm not in love with all of this chart, but there is something I do use on this kind of a chart. The data here is the kind of data that is what I call a alternative data source. It's looking at data that other people don't look at. I actually am aware of this particular data set. And heads up, I'm not going to tell you what the vertical axis is, but this is the kind of stuff that the AI looks at too. I can tell you that on this particular thing, they're showing the sentiment here. The AI has not been able to vilify this particular data. In other words, when I use AI and I use that data stream doesn't come up as an effective data source to be able to use to predict price. So I can't determine price discovery from the data there, but I'm very well aware of it. So this is one of the things that a person puts up a chart, but they haven't done the deep research to see if there's any connection with price discovery and their data. So the chart means nothing to me without some analysis of the data itself. And the analysis I've done tells me there's no value to that data, albeit that it looks kind of right, but the math doesn't support the chart. So everybody, all I'm doing here now is to say that I do keep an eye on this. I want us all to be careful, and I want everybody to even remind me, say, Kelly, make sure you're not pounding the table how bearish you are, because I will not do that. I have learned many times that this is America. Generally, America finds a way. And when it finds a way, it generally works out well. Right now, the country's got its problems. We all know it. I think we stay out of it. The country will present, along with the markets, a great opportunity in the months to come. But today, I don't feel we have evidence enough to do it, both from my own personal knowledge and experience, and also mathematically, I got nothing that I can provide to say that I see any possibility of changing of AI to signal a possible buy event in almost any stock. If there is a few out there, if they occur and you have them in your portfolio, no, you will get long. And that's good. And that's why we use the math. If we stick to that, we're going to all be fine. Are there any other questions from anybody?
Yeah, I'll just fly through them. If you have questions at this point, ladies and gentlemen, and in the audience, please submit them into the YouTube chat. I think by now everyone already recognizes this is the way it's going to be. There is no Zoom link anymore. Just a little bit of housekeeping update there. I did get a question from Michael saying, when are the Dallas recordings going to be sent out? Now, I do want to clarify that the recordings are only available to the people who attended and or purchased the ticket, but couldn't attend for whatever reason. Like one person got COVID and couldn't come, right? Thank you for not attending. So in other words, you have to, they're available for purchase. They're not just going to be, oh, thank you. Thank you, Tony Stark Polici. Iron Man himself is endorsing the event. Thank you very much. He was there. We had a great time. So they're available for purchase. They're not just going to be uploaded for free on YouTube. Email me separately about that if you want more information about that. There was another question, Kelly, if you could answer this one from Mark Hattis. Mm-hmm. Could dislocation between Dow and NASDAQ be due to money moving from here to overseas due to the financial troubles of the other countries? Is Dow maybe a safety play, a place to park money? I think I know what you're going to say about that, but it's an interesting thought, right? Dislocation between Dow and NASDAQ because of money moving from country to country?
That's certainly possible. I've seen that kind of thing before, but I don't think so in this case. And if there is, I think it's minute. I think what's happened is, if you look closely at the markets in general, you'll see that when markets get more volatile, as they have become over the last 6 months, and certainly over the last few months, the more they become more volatile, the more likely the markets become bifurcated. today is an example of one stock doing the tech stocks doing very poorly. It was almost exclusively tech stocks that dragged down the S&P and of course the NASDAQ. But most of those stocks didn't drag down the Dow the same way, because some of them are just not in the Dow. So I've seen this a lot more than you think. I thought today's was very noticeable though, because the Dow struggled all day to be positive, tried to be positive. Even the NASDAQ was positive for a brief amount of time. But at the end of the day, the weight of the market is just so overwhelming that it pulled the major indices, which is the S&P 500 down, as well as the NASDAQ. So no, the NASDAQ today, if you just look at the top two companies, look at these two companies. All it takes is these two companies to go down like that, and then add Google to it. Google was down almost 10% on the day, folks.
Mm-hmm.
And this is what happened to their rally. Their little rally was shot down in flames in a day. That tells you that is not far behind for something like Apple to report bad. And I think Apple could lose 20% in a day. And I love Apple. It's been a holding of mine for years. And it's the only one thing I can generally stick to. But no, not in this case. I don't think it's internationally based. I think this is just a simple dislocation. It will adjust itself somewhat tomorrow. So tomorrow I would expect the Dow to be worse in performance relative to the NASDAQ on just a daily basis.
Right.
Just a daily basis. Right now, this to me looks just like a simple arbitrage.
Gotcha. Okay. Our next question comes from Amy Lau, who asks, any update on the housing market in terms of interest rates? Can you speak to the housing market?
I can speak to it, and I will, because I'm allowed to opine on here.
Yeah.
I don't like it for now. Interest rates, I think, have hit a spot where it's very difficult for people to buy. We're running close to 7%. So if you don't have the best credit and a lot of money down, it's going to be hard to buy a house. That being said, if you have, look, the median house price matters. If you live in San Francisco, like I think Amy does, then median house prices are extremely expensive. If you can find multi-dwelling homes or things like that can pay incomes, and I know that works in San Francisco a lot, possibly there's some opportunity, but it's risky bet to me right now. And if I was building a house, I would not build it. I'd wait at least 6 months to see where interest rates are. At the end of the day, we all know real estate is a local market. I'm involved in some real estate. It's purely as an investor in North Carolina, for example. And in North Carolina, the builder out there builds $250,000 single family homes. That market is still able to exist because the houses, they're below the median price house in that area. And there's a huge need for housing and rentals. But I can tell you this, before those houses were always being bought by Blackstone. Now they're just subject to the market. In other words, I've noticed the hedge funds have stopped buying houses. So whatever that's worth, Amy, I don't know, but I'm not going to be buying it if the hedge funds and Blackstone and companies like that are not.
And I think that's it. If you have any other questions, now's your last chance to get them all in. And, just as a quick announcement in the meantime, for people who did purchase a ticket for Mastering the Markets, the recordings will be made available next week. So we had a little bit of a delay with the videographer's cloud drive, and that's how he's going to deliver the recordings to us, right? And so I'm dealing with that. So apologies for the delay there. Obviously today I have the AI Circle, then tomorrow I have another event. So it's a lot of it is just my busy schedule in processing and editing and delivering your recordings for you. But it will be made available next week. And if that's all the questions that we have, I think that's it. That wraps us up for JJ had to sneak one in there. Has the VIX bottomed? What do you think, Kelly? Has the VIX bottomed?
I'm not willing to say that either. No, I don't think the VIX is topped, but I don't think it's bottomed. I don't pay attention to the VIX when I see the market going up. I don't look at that. I just care about how the VIX increases when the market goes down. The relative value, market goes down 5%. I expect the VIX to maybe go up at least 20%. I care about the ratio on down moves, not on up days. So no, my instinct is it has a little bit of a bid to it right now, but it's a bid that I think will wane. And so maybe it got a little bit lower to go. And then maybe find your area if you're gonna go short, then find your area. But no, I don't pay enough attention to the VIX in that way to be able to give you a solid answer. Sorry, JJ.
He just wanted to throw my sign off rhythm, like off my rhythm when I'm signing off here. He just wanted to squeeze that question in there. Anyway, thank you everybody for joining us this evening. That concludes the October session, episode 6 of AI Circle from iFlip. Make sure you like and subscribe if you enjoyed the show, and we will see you next time. We will see you in 2 weeks for the iFlip mailbag show. Stay tuned and good night.
Good night, everybody. All the very best.